For decades, the Democratic Republic of Congo, a Central African nation of more than 100 million people, has grappled with bloody militia violence, including ethnic and resource-driven armed rebellion by M23 and dozens of other armed groups. Roughly the size of Western Europe, the war-riven country is endowed with vast mineral wealth, including the world's largest reserves of cobalt and coltan, both critical to the production of electronics. Cobalt is used to produce batteries that power cell phones and electric vehicles, while coltan is refined into tantalum, which has a variety of applications in phones and other devices. And now, US President Donald Trump has expressed interest in minerals from this resource-rich nation. Here's a report.
The United States is in talks with conflict-plagued Congo on developing its mineral resources under a deal. The Congolese president says the deal with U.S. could help make his country safer. U.S. President Donald Trump's senior advisor for Africa, Masad Boulous, did not provide details of the potential deal following talks with Congo's president Felix Tshisekedi in Kinshasa, but said it could involve multi-billion-dollar investments. Boulous said American companies would be operating transparently and would stimulate local economies. Congo is the world's largest producer of cobalt, a mineral used to make lithium-ion batteries for electric vehicles and smartphones. It has also substantial gold, diamond, and copper reserves. DR Congo has been battling Rwandan-backed M23 rebels who have seized larger areas of territory this year. Tshisekedi believes U.S. involvement in extracting the minerals could help quell the violence that has plagued the east of the country for nearly 30 years. Currently, DR Congo's mineral wealth is largely dominated by Chinese firms. Aside from security reasons, there are also economic motivations for pursuing the deal. Mineral and oil-dependent African economies are in distress as they face several fiscal imbalance of payment deficits. From minerals to oil and gas, commodity prices have collapsed in the last few years. The price of copper, for example, has dropped by 67% and oil by 51% since 2011. The slump in mineral prices is not bad news for all. Consider the case of mining companies. After reaping windfall profits at the peak of the commodity price boom, the plunging value of the currencies of many African mineral-rich nations is helping mining companies to cut their costs further. South Africa-based gold miners Gold Fields Limited, which has operations in South Africa, Ghana, Australia and Peru, said its cash costs declined 3.1% in second quarter of 2015 from a year earlier to $1,059 an ounce. From Ghana to Zambia, attempts by various African nations to review their fiscal regimes and tax provisions in mining contracts to raise additional revenue to fund development were mostly unsuccessful. The continent ranks first or second in global reserves of bauxite, chromite, cobalt, industrial diamond, manganese, phosphate rock, platinum group metals, soda ash, vermiculite, and zirconium. Natural resources are finite. It is therefore essential for resource-rich African nations to tailor their economic policies to effectively harness and utilize these revenues to improve the productivity of non-mineral, oil and gas-related sectors to break out of the extractive enclave. A recent example from Malawi vividly highlights how the current international financial architecture and mining immensities are bleeding African nations on investable capital through IFFs. Malawi lost $43 million in revenue over a 6-year period from a single Australian mining company, Paladin, which owns a uranium mine in this impoverished southern African nation. The company used complex corporate structures to exploit loopholes in international tax rules after negotiating a huge tax break from the government. Historically, the extractive sector operates as an enclave with very minimal linkage to the broader economy. Africa Bureau, WION World is One.
For all the latest news, download the WION app and subscribe to our YouTube channel.